Hi, I'm Karen Ward.
And I'm Hugh Gimber. Welcome to JP Morgan Asset Management's Markets Explained.
Your weekly briefing, where we cut through the noise and focus on what matters most for investors, setting you up for the week ahead. So Hugh, it's 1st of June already. Can't believe we're already at this stage. But generally, markets happy. We had another good week last week. And part of that is this hope of an Iranian deal. Oil actually got into the low 90s last week. So that question we were asking ourselves about where will oil normalize to, we got a little bit of a glimpse that it could come down significantly. But the slight puzzle is oil was coming down without a deal officially being announced. So where are we in terms of this deal?
Yeah, so let me start with the facts. We had US officials briefing out last Thursday that the framework of a deal was coming together, and that was going to do two things. Number one, extend the ceasefire for another 60 days. And then second of all, launch formal talks on Iran's nuclear capacity, effectively, and the stocks of uranium that they hold. So for me, there was a big signal for markets here, which isn't about a deal immediately being struck, but it's about the willingness of both sides to say, if there's something we can't agree on, let's kick it further out into the long grass and let's get the Strait reopened now. Because within that ceasefire, if this deal is struck, there was talks of both sides removing the blockade on the Strait of Hormuz, the US even being willing to waive sanctions on Iranian oil sales. So this, I think, would send a very clear signal to the market. The Strait is open, restock as quickly as you can, even if some of those longer-term sticking points remain unsolved. And so just as a refresher, that's number one, uranium and Iran's nuclear capacity. That's two, about who is in control of the traffic moving through the Strait. That's three, about Iran's frozen assets and pressure on Washington to release those. And then four, the conflict in Lebanon with Israel's involvement as well.
And I guess even if the Strait hasn't been officially reopened and an official deal hasn't been made, there's also quite a lot of noise about how a number of vessels have actually managed to exit the Strait, though. I think Bloomberg are reporting that a quarter of the trapped vessels have actually now got out. Some of the estimates are higher than that. I mean, we don't know officially, do we? Because you can turn off your tracking as you exit the Strait when you are a vessel. So it's kind of hard to know. But that would suggest that some of the energy trapped is getting out into the global market. And importantly, the more vessels get out and unload their cargo, the quicker they can get back in and start reloading in order to take that energy off the Gulf. Because we know the Gulf states themselves have filled all of their possible storage tankers. There's plenty of energy waiting to go. It's literally the transit.
And this comes back to a point that I think we've discussed before here, Karen, around not needing a formal deal. It's not about reaching that grand agreement and markets being able to say, aha, now we know that things are solved and we can react accordingly. Markets always looking to front run that announcement, and that signal that oil is starting to flow again, I think, is one of the key things to be tracking.
Yeah, absolutely. So we'll continue to watch what happens there, not only, as you say, whether there is a deal or whether it's just actually ships exiting. So I'll keep my calls into our transport team for any information they can give us on that. I guess the other key question this week is information we're going to get from the US labor market. So it is, as we often call it, payrolls week. On Friday, we get US employment, but we also get a trickle of information from other sources through the course of the week about the shape of the US labor market. And I think this is quite important to markets in this backdrop, because as we said last week, markets have almost taken comfort in this oil shock from the fact that even if companies have got to worry about higher energy costs, they haven't probably got to worry about much more higher interest costs. And that's because the central banks will look through rising headline inflation, because ultimately the labor markets have been very soft. So that's where I think the market's going to be looking at this release this week. Is it still the case that even though US growth has been spectacularly strong, the labour market is weak, and the expectation really is for a pretty subdued print. 85,000 expected to be the increase in payroll employment in May. That's a little bit down from last month, but that's still a pretty tepid pace of job growth. And I guess, Hugh, one of the questions about why there's been this sort of disconnect between a really strong economy and a relatively weak labour market, it has been two possible theories. One being it's just cyclical because of all the political concern. Maybe companies are just more hesitant about converting orders into new jobs. The other question, of course, is that the jobs aren't needed because AI is going to be doing, and the robots are going to be doing all of the work from here on. So what are we actually seeing in the data to answer that question?
Yeah, I suspect this is one of those scenarios where, depending on what you believe, you can probably find a piece of data that will back up that theory. If I just go through some of the different sources that we're following, first of all, in the official payroll growth, we can look at this by sector and see that recently the weakness has really been coming in a few key areas. So the first is government hiring, and we all think back to the pressure on different government departments in the US to slow hiring as part of the efficiency drive that started President Trump's second term. The second is financial services, and maybe you could say that that is one of the more AI-exposed sectors out there. And then third itself is tech. Probably unsurprising, given some of the comments that we heard from tech CEOs during the recent earnings season, talking about enormous proportions of their coding now being done by their own large language models. So that sector breakdown would say, okay, maybe there is something of an AI story here. If I then look to some of the data that we get from the Challenger Gray and Christmas report, so they track not job growth, but purely job cuts. So this isn't a net figure. This is all about announcements of layoffs in the US. About 16% of all of the layoffs that have been announced so far this year have been with companies citing AI. But I do think you have to ask the question here, if you're a business looking to lay people off, how willing are you to point to these amazing productivity enhancements coming from the way that you're using AI versus telling the market, actually, demand's just been a bit soggy, or maybe we've made some hiring mistakes and now want to reverse them. So I take those numbers with a pinch of salt, particularly then when I throw into this another source that we look at, which comes from the Indeed jobs website. And this is a goldmine for economists, because not only do they tell you about where businesses are planning to hire, they also tell you how much they're planning to pay people. So this data tends to give us a pretty good lead on lots of the different labor market indicators. And if I zoom in there on software developers in particular, arguably you would think one of the most AI-exposed subsectors today, we see a very clear pattern where during 2021 and 2022, this was a world where we were all going online, all stuck at home, all remote working was booming. And so they overhired massively during that period. Since then, there's been a very clear slowdown in hiring. But actually at the margin over the past 6 to 12 months, when this AI story has really been gaining speed, job postings have been going up for software developers, not down in the US. So I appreciate this all gets a bit weedy for a Monday, but I guess the key message here is that there are lots of arguments pointing in different directions, and I don't think we can make a clear statement today to say, yes, this slowdown is definitively because of AI, rather than businesses simply looking at the world and thinking, this is a pretty uncertain place, so maybe I don't want to make big hiring plans at the moment.
Yeah, absolutely. I mean, we looked at the UK data as well, and a very similar picture that you definitely can't draw a conclusion that it's AI causing labour market problems, because a lot of the weakness has been in leisure, hospitality, young age groups. Probably part of the problem has been very rapid increases in the minimum wage, national insurance contributions for employers, and that I think has been the problem there much more than AI. So not clear that AI is taking all of the jobs just yet. Who knows if it will in the future. But I guess circling back into how this payrolls report could affect this week, the market's expecting this to be helpful, isn't it? It's a tepid labour market, wage growth still moderating, so average hourly earnings expected to ease to 3.4%. So definitely not going to feed the idea that the Fed's going to have to be jacking up rates anytime soon. I guess in the rate discussion, the other information we're going to get this week is inflation out of Europe. And we have heard a rather different tone from the ECB, as Lagarde the president of the ECB, she said, what is a reaction function if you don't react? So it does seem that the ECB feel even if just headline inflation is on its way up, they should be doing something about it. And they probably are going to learn when the data's out tomorrow that both headline inflation and core inflation are on their way up. And that's going to, I think, lock down a June hike, which is already well priced by the market when they meet on the 11th of June. I mean, personally, I don't actually think that's great policy making. I think if you take rates up when headline inflation goes up and then take them down when headline inflation goes down, you're probably going to add to economic volatility rather than smooth it. But, either way, I guess they're thinking that they just need to show that they are committed. But overall, I think, the ECB do seem to stand out, don't they?
Let me play devil's advocate for a second here, though, because you have the ECB with a different mandate to the Fed. They don't have the labour market aspect. They're only meant to be thinking about inflation. And so if you see inflation north of 3% and rising, why wouldn't you be hiking at the moment?
Well, I mean, I think although the mandates officially are different, I don't think they actually are. I mean, they all have a medium-term price stability. And my point here is that if headline inflation goes up, but there's no sign that wage growth is going to follow, that's going to really squeeze disposable income. So if headline inflation goes up and you raise interest rates, the chances are you overly weaken the economy, and therefore next year you're dealing with an undershoot of the target. So I do think it's central banking should be much more subtle about looking to the medium-term price pressures in the economy, however your mandate is defined. But yeah, we're getting into techie central bank details there. I guess those are the key things going on this week. No news as yet on UK politics. Obviously still waiting for the Makerfield by-election to know whether Andy Burnham is going to be able to take an MP position and challenge Keir Starmer.
And Karen, you had a conversation last week with Anand Menon, which was all about the UK and whether the country's ungovernable. I thought it was a slightly cheerier listen than I was expecting it to be.
Yeah, I must admit, when we started the conversation, and Anand is a professor of political science, I did think, oh my goodness, this is going to be a pretty grim hour. But I think what it helped me realise was that, politics is a game, and you have to, when you're speaking to the electorate, you have to play the game of saying what they want to hear, particularly at the right times. Whether that actually comes to fruition when you're about to take office or in office is quite different. So I feel like here in the UK, as one person said to me, aren't we a basket case? I don't think we are. I think we've all got the same challenges in the West of, lots of societal issues, whether that's should pensioners get the money, should students get the money and student loans. We've got all this sort of intergenerational conflict, which is creating all sorts of fiscal challenges. But actually, all of those problems are across the West. It's just that the electoral cycle means that we are in focus today here in the UK. I suspect next year it will be France that's in focus and it will be the US that's in focus later on in the year. So I actually came away thinking it's all going to be all right in the end.
And just think how much more popular politicians will be if England win the World Cup as well. It could be a very well-timed distraction for our political colleagues.
Yeah, I think that's a stage of optimism too far, but I like it, Hugh. That's a really nice note to end on. Of course, it all starts quite soon, actually, isn't it? Goodness, poor me in my football madhouse. I might just book myself a holiday on my own for how long does it last? Is it weeks?
Months.
Oh my goodness. Okay, all right. Well, I'll go and investigate a trip on my own somewhere, and we wish you all a really good week. As we've said, please do like and share to anybody that you think will find this podcast helpful, and we're really grateful you spent the time with us.
This communication is educational in nature and not designed to be taken as advice or a recommendation to buy or sell any investment or interest thereto. It is based on assumptions in current market conditions and are subject to change. It should be noted that the value of investments and the income from them may fluctuate in accordance with market conditions, and investors may not get back the full amount invested. Past performance, yield, or forecasts are not a reliable indicator of current and future results. JP Morgan Asset Management is the asset management business of JP Morgan Chase & Company and its affiliates worldwide.